Good afternoon, everyone. I know some people are still in line. We're slightly over capacity. That's awesome that all of you could make it out after so soon coming back from recess. But I'll go ahead and get started, and you guys can, hopefully we'll be able to find seats as we go. My name is Satya Thalam. I'm the director of the Financial Markets Working Group at the Mercatus Center at George Mason University. I'm assuming most of you have come to one of our programs before, but if you're not familiar with the Mercatus Center, it's a university-based research center that focuses on the economic analysis of regulation and public policy making. And today we're here to discuss credit card, payment card, interchange fees, an issue that probably for many years was pretty obscure, nobody cared about, but fairly recently has become front page news in a lot of the policymaking circles, especially with regard to the FinReg bill that's making its way through the joint conference. The credit card interchange fees is kind of a weird topic. We're used to, both as academics and policymakers, thinking about regulation of goods and services. We sometimes set prices. We decide what can be in a product that you offer, how you can offer it, who you have to offer it to. But we're not used to thinking necessarily about how to regulate payment for those goods and services. So in some sense, we're talking about regulating a fundamental market mechanism, not the market for anything, but the mechanism by which we transact. I remember, and probably most of the people in this room have, for most of their lives, taken for granted the use of some sort of plastic payment that we use around the world. We can use in any corner shop. We can use for purchases both small and large. And we don't think about exactly how that works, even though it's ubiquitous and it's kind of a background noise to everything that we do. I remember, for whatever reason, credit cards, the use of credit cards, that concept was never even foreign to me. I never really asked my parents how that worked, but I did ask them how a check worked because that seemed more foreign to me, that this piece of paper you'd write on. I remember asking my dad, how the heck does this thing work? It was right after I was 6 and I was practicing my signature on all of his checks, and that was right after that discussion. I didn't realize that they were actually worth something. But even in economics, there's a specialty called monetary economics that focuses on especially the operations of a central bank, Federal Reserve, the use of legal tender, how those are inserted and taken out of the market. But again, most of those economists, most monetary economists, do not focus on the use of payment cards and the interchange networks that allow them to operate. It's even though it is quite widely used. So I'm glad that we were able to have two of our colleagues, Todd Zywicki, who's a member of the working group, is also a senior scholar at the Mercatus Center and a chair professor at George Mason Law School, who's been working on this issue, especially in the context of the general issue of consumer credit, consumer lending, consumer protection issues, and Jeff Manne, who's a lecturer at the Lewis and Clark Law School, who's executive director of the International Center for Law and Economics, and an adjunct and various member of other working groups and institutions. I think we're going to start with Todd, who's going to give us more of a macro overview of the trends and dynamics of consumer lending, of consumer purchases, the market, how these things have changed between different types of mechanisms, and then Jeff will be able to get into more specifically the economics of interchange fees of payment cards. I'll remind you at the end, but after we do Q&A, there's a survey underneath the copy of the slides that should be on everyone who has a chair. Underneath the one, we asked that at the end before you leave, if you could just fill that out briefly and hand it back to us, because we do use that. So with that, Todd Zywicki.
Thanks, Satya. I see a few people out there who are of my generation and age, and so maybe afterwards we should tell Satya about traveler's checks, if we really want to rock his world about how we used to shop around the world. There it is. All right, I'm going to spend the first half of the time today just talking generally about credit cards and how to think about credit cards. We could talk more about credit card regulation, but in the Q&A in more detail. But I'm going to spend about 25 minutes or so talking about credit cards generally in the credit card market, and then Jeff's going to talk about interchange, which has obviously become a much bigger issue in the past few weeks. So I think, you know, I'm a credit card enthusiast, to put it simply. I ask, I think in my mind at least somewhat rhetorically, are credit cards the greatest invention since money? And I think the answer is probably yes, the way they've transformed and revolutionized the world. And if you just think about it from the consumer perspective, e-commerce doesn't exist without credit cards and payment cards, right? I mean, if you just think about that, the ability to shop online, that in and of itself is a pretty dramatic sort of thing. You can't have that without widespread ownership and acceptance of credit cards. Another thing that's very important that we're going to come back to again and again is the way in which payment cards have unleashed greater choice and competition for consumers. And in particular, one thing I want you to think about in terms of thinking about the regulation of credit cards and interchange fees in particular when we get to that is up until the past 20 years or so, since the 1930s, people have used credit. In the 1930s and 40s, I mean, people seem to think that using credit is this new thing. Every generation thinks, it turns out, that we're not as frugal as the prior generation. You can go back to the 1870s, and you can see people complaining about what spendthrifts we are, right? The theory of conspicuous consumption, where people are going into debt just to impress their neighbors. Thorsten Veblen, 1898. Right? So it's kind of a ubiquitous thing that we'll come back to. But the point is that in the 30s and 40s, 60-70% of appliances, encyclopedias, sporting goods, hardware, all those sorts of things were bought on credit. But what they were bought on was retail store credit. And what credit cards have done that is really quite a transformative thing is to disaggregate the issuance of credit from the retail shopping experience. And what that has really done is empowered competition in both those markets. It used to be you shopped at the local department store because the local department store would give you credit. Now you can get your credit from here and get the best offer there, and get the goods over here and get the best offer there. That is an incredibly powerful instrument for competition in both the credit market and in the consumer market. And that's an important thing to keep in mind, as Jeff will talk about later. Secondly, Satya referred to travel. You can go anywhere in the world right now without a penny in your pocket, really, and you can live. You can get a hotel room. A thing that I think is funny is nowadays you can buy a car with a credit card. Without a credit card, you might not even be able to rent one, right? Which is pretty extraordinary to think about. When you think about day-to-day life and you think about things like how inefficient other payment systems are, cash is incredibly inefficient. If you think about how aggravating it is to have to get money from the ATM, to go out of your way to get money from an ATM, to pay service fees for an ATM if you want to do that, all of those sorts of things. And then you've got the risk of theft, you've got the risk of losing your money, all those sorts of things. Checks are a joke. Let's be serious, right? I mean, checks are, we're talking, 15th century technology with checks. British banks have announced that by 2018 they're getting rid of all checks. Hopefully they'll get rid of it sooner, but checks are a ludicrous payment system now. And when you think about how long it takes to write a check at the grocery store, for instance, the fact that people won't take out-of-town checks. Checks have seen their day and they're gone. And then you get all these other sorts of benefits that benefit consumers. I think the most important one personally is 24-hour customer service. As opposed to your local bank, right? In the good old days when you had to take off work to go to the bank, right? You could do 24-hour customer service. Dispute resolution, I think, is another important thing. There's also very important benefits to the economy and merchants that I've alluded to. I mean, the first is, again, just the cost of cash. The Federal Reserve budgets $600 million a year simply to print cash. One estimate in Europe was that there's one European country, I don't remember what it was, but they could save 1% of their GDP if they would get rid of all their paper-based systems and move to electronic systems. The federal government doesn't cut checks anymore, right? It's basically all done by prepaid cards, unless the Durbin Amendment goes through, in which case then apparently a lot of states will probably stop using prepaid cards and that sort of thing. Cash, you've got the problem, just think about how much money we waste on armored cars, right? paying people to drive around pieces of paper with guns. Right? I mean, what's the loss to the economy of people driving around pieces of paper with guns and guarding safes and doing all these sorts of things? It's nuts. Benefits to the economy, entrepreneurship, credit cards and widespread use and acceptance of credit cards. 3/4 of small businesses, small independent startup businesses, rely on credit cards, often their personal credit cards, to get businesses going. That only, and for a lot of those guys, they can't get small bank loans. They don't want small bank loans. It's basically for people who are working part-time and that sort of thing. Credit cards are the vehicle they use to start up businesses. And versus in-house credit, which I talked about earlier, credit cards are much more efficient than in-house credit. First issuers are better risk bearers. They're experts in it. Citibank knows more than your local grocery store about about a risk analysis. They can invest in more efficient fraud prevention. We talk about in our working paper that you can get on the ICLE website about the neural network programming that the credit card networks use in order to try to pick up fraud in real time. And if you know, I mean, this happened to me recently. My wife inadvertently used her credit card for a cash advance when she thought she was using her ATM. Literally within 3 minutes, I got a call from our bank who issued the card and said, "Did you authorize this charge?" Right? Because we'd never taken a cash advance before, and it was and she thought she was taking out money by the ATM. But boom, that's how quick they are to be able to diagnose the threat of fraud on your account. Those kind of investments can only happen if you're doing it at the network level, not at the local department store level. And most importantly, I think it allows small businesses to compete. I talked about that earlier, right? But it used to be the only ones who could sell stuff on credit were the ones who could afford the high operating costs and the risk of issuing credit. Big department stores like Sears, Penny's, things like that. Small stores couldn't sell on credit. So you couldn't get small boutique stores, for instance, that specialize in a particular type of electronic goods, for instance. Why? Because they couldn't bear the risk of selling $2,000 worth of stereo equipment to somebody and not have them pay. Credit cards allows them to compete on the same footing with somebody like Sears or Target or somebody like that. And you see this kind of substitution going on over time, which is if you just look back to 1970, what you see is the yellow line is bank type cards. You see a dramatic rise in the use or the ownership of bank cards, percentage of households holding bank cards. And what you see is retail cards peak in the late 80s and they've drifted back. And basically what you see is every single year now, or every time the survey of consumer finances come out, what you see is a drop in the number of people who have department store cards, who have gas store cards, and those sorts of things. Bank cards have basically replaced those, basically because they're more useful both for consumers and for merchants. And so what we have is a process of really quite robust competition where consumers have a lot of consumer choice. There's thousands and thousands of banks issuing credit cards. Every merchant takes credit cards. And this is based on research done by Thomas Durkin, I think in 2000 or 2002 of the Federal Reserve. And what he found at that time is that, as you would expect in a market with that much competition, 91% of consumers were generally satisfied with their dealings with credit card companies. 90% said, my credit card companies treat me fairly. 86% said it's easy to get a credit card from another company if I'm not treated well. And everybody knows that. If you don't like your current credit card, go home. And there will probably be about 3 other companies that want your business in your mailbox today, right? And this is one I think is really interesting, is 73% of consumers say having credit cards makes it easier for me to manage my finances. Only 10% says it's more difficult. 73% say it's easier. Why? Number one, credit cards give you an itemized purchase statement of every purchase you make, or electronic cards do. There's an interesting survey done just last year in Italy. 47% of consumers say that they forget substantial purchases that they made in the previous month, right? And basically they use their credit card statement to remind them, right? So basically what it is one of the things that's annoying about cash is it's actually hard to manage your finances. It's hard to remember where you spend your money if you're using cash. It's a little bit easier if you've got checks. It's really easy if you're using electronic payments because they remind you at the end of every month. So number one. Number two, 73% of consumers think that the rollover option, the ability to, if I can't pay my bill or don't want to pay my full bill this month, to be able to roll over to the next month makes it easier to manage my finances. Now, obviously, some people slide or they slide for a while, but by and large, most people think that's a benefit, and most people think it's easy to get information on credit terms. That's something that we could do better. We could talk about how we could do that better. I think that what we've done is managed to take what was an elegant system of disclosure-based regulation and mess it up. We could talk about how we've done that. In my view would be that there's a lot that should be done to make disclosures better. Instead, we're making them worse. But 65% is pretty good. I'd like to see that higher, and I think there's things we could do. Now, here's the interesting thing about it is, even though 92% of people say they're satisfied, 31% say that it's 31%, only 31% disagree that most people are satisfied in their dealings with credit card companies, right? Well, my credit card company treats me fine, but all those other guys are getting ripped off, right? 41%, this is astounding, 41% agree that consumers would be better off if there were no credit cards, right? I can manage my finances. It's all those other guys out there who can't. 53% say credit cards make managing finances easier for others. 40% say it's more difficult for others, right? So what we have here is really quite a dramatic a difference of perception between how people actually behave and what they believe. So, credit cards are, I think, by and large, quite a positive innovation. And there's a few concerns, though, that people have raised, and I want to spend a few minutes talking about that because I know this is something that is on people's minds. And in particular, we have our concerns about over-indebtedness, high interest rates, hidden fees, also nowadays apparently known as tricks and traps, and complexity. Don't peek yet, and I'm going to ask you a question now to raise your hand, and if you've peeked, you're not allowed to answer. But I'm going to unveil the answer in a moment when it comes to hidden fees and tricks and traps. How many people here, raise your hand, think that credit card companies make more than, say, 30% of their revenues off of penalty fees? Late fees, things like that. How many would say that they make more than 20% off of penalty fees? 10%? Okay. All right. Well, I won't test you later, but you can just remember your answer, and I'll show you the answer in a minute. So, but first, let's talk about the first concern, which is over-indebtedness. The concern is that credit cards make people put people more in debt. Now, that's not true. And again, the way to think about this, especially for middle-class people, is what we have seen is a great substitution from retail store credit to credit cards. So most of you are too young to remember this, but if you wanted to buy a refrigerator or a bedroom set 30 years ago, what would you do? You'd go down to the local furniture store, the local department store, you'd open up a credit account, and you'd open up an installment loan, and you might pay $150 a month for 36 months until it was paid off. You might be paying an implied interest rate that would be buried in the price of the goods. The implied interest rate might be 20 or 30% often for that because of the cost of running that operation. If you needed $2,000 to repair your transmission, what would you do? You go down to a local personal finance company, you'd open up an account, you'd pay $100 a month for 24 months until it's paid off. You'd probably pay the equivalent of about 25% interest for that, right? Now, if you needed a car repair now or a refrigerator, who would think you would go to a personal finance company or open up a credit account at the local department store, right? Of course not, right? What do? You just put it on your credit card. Why? Because credit cards, number one, have lower interest rates. Even though they seem high, they're lower than what preceded them. And number two, because of this flexibility, that they are accepted everywhere, and you have the option of how much you want to pay every month, right? So what we know is that a huge portion of the growth in credit card debt is simply a substitution from those old types of credit to the new types of credit. How much? Well, the best data we have, somewhat surprisingly, suggests all of it. 100%. And I'd be willing to, look at data that showed that it was less than 100%. But intuitively, we know it's almost all of it. right? And we know that by the fact that those other operations simply don't exist. This is what we call the debt service ratio, which is the amount of income you spend each month in order to pay your bills, right? So basically what it takes account of is how much your outstanding debt is, what the interest rate on that debt is, what your payment obligation each month is. So your student loans, your mortgage, your credit cards, they have a number for calculating credit cards, your car payment, your home equity loans, those sorts of things, right? And then they take into account the interest rate. And what we see over time, if you go back to 1980, which is the earliest the Fed has this data, what we see is that the debt service ratio was around 12% of household income on average, kind of bounced around, and then it takes off here around, around 2004 and whatnot, and bumps up there. Why is that? That's basically something you may have heard about, which I think they call the housing bubble. Was right here. What we see is a big boost in mortgage debt service ratio beginning around in the early 2000s. But otherwise, what we see is during this period, we see pretty much a flat rate. Why? Basically because interest rates were low, better quality products like credit cards were replacing worse quality products like installment loans. And in particular, if you disaggregate that and take out this distorting effect of mortgages, what you see on consumer debt is really quite striking, which is if you combine installment debt and revolving debt, what you see is the figure in 1982, which is for some reason as far back as I have this data, was about 5.5%. The figure in 2009 was about 5.5%. It went up, it went down, it went up, it went down. But basically, what we've seen is a almost perfect substitution of revolving debt for installment debt, just like I said, right? Which is revolving, non-revolving installment debt goes like this, revolving debt goes like that, and now they've basically leveled out. Now that substitution effect would be even greater. If people are concerned about debt, obviously we need to be concerned about housing debt, but if you're actually concerned about debt, do something about college debt. The explosion, the only reason why this drop in installment debt stopped in the early 90s was because what we got right here was people loading on incredible amounts of student loan debt. I mean, it's extraordinary when you look at the data. That's where the indebtedness is coming from now, is growth in indebtedness. Here, what we got was around 2000 to 04, for various reasons, people started leasing cars less and buying cars more. And so what this basically reflects, this hump here, was people shifting over from leasing to buying cars because of low interest rates and things that people are trying to do to get them to buy cars. And this used to be more impressive a few years ago when I would quote Alan Greenspan making this observation. It doesn't have quite the cachet that it used to have, but Greenspan made this observation. Finally, even if you look at bankruptcy filers, what you see is the same thing. Is you see total debt has actually declined a little bit for bankruptcy filers. What you see is a drop in secured debt, which would be that installment debt again, and an offsetting rise in credit card debt, right? Which means that the total debt of bankruptcy filers has basically stayed the same or even declined a little bit. So that's what's going on. One other way of looking at this is this is data that goes back further. Ratio of consumer credit to household assets, right? This is not income percentage, which is what I was saying earlier, how much you got to pay each month, but to assets. What we see here is that since the early 60s or so, the ratio has been largely constant, around 3.5 to 4%. This right here, this is consumer debt, not mortgage debt. What's going on from 1945 to 1960? Levittown, right? This is basically, Levittown was created with debt. The suburbs were created with debt. People bought houses, they got mortgages, they moved out to the suburbs, they bought cars, they bought furniture. They basically, and so basically what happens, we get the great boom in consumer debt into the early 60s, and then since then it's been a change in the composition of debt, but not a change in the overall indebtedness of households. This you can look at on your own. I could talk about it more, but this basically shows that the same patterns have gone on with lower income Americans. Credit cards have penetrated down lower into the socioeconomic stratum, but for most for lower income and sort of moderate lower income people, it's the same effect, which is basically a substitution effect. This chart you can look at on your own also. It basically shows that there's no evidence that credit cards have been incredibly risky either, right? Which is that delinquency rates on credit cards are always higher than for other things, but they basically follow the same pattern as for other types of loans. So what's going on here? Well, I suggested this earlier, which is what's really going on is credit cards are more flexible and they're cheaper than what preceded them. So if you take the next closest measurement, which would be a 24-month personal loan, what we see here is that credit card accounts prices have fallen such that they're about the same as a 24-month unsecured personal installment loan. That doesn't take account of the fact that you've got to pay an application fee and things like that when you get an installment loan. This is just the interest rate. And this is why credit cards are easier and why they've gotten rid of the personal loans over time. And the other thing that's interesting is if you look at these yellow boxes here, these are credit card accounts assessed interest. It's typically the case that credit card accounts assessed interest actually have a lower interest rate than all credit card accounts on average. Why is that, do you think? Well, because people who revolve their debt shop on the interest rate. If you don't revolve your debt, you don't shop on the interest rate. I don't know what my interest rate is. I'm betting Alden Abbott here doesn't know what his interest rate is because he pays his bill every month. I know Alden. I won't ask Gordon whether he knows his. But basically what happens is, and the evidence is quite clear on this, which is people who revolve debt know their interest rate, they shop on their interest rate, they're very acute to that, they switch to card based on their interest rate. Those of us who don't revolve our debt don't know our interest rate because it's an irrelevant term for us. I shop on the basis of benefits, customer service, and those sorts of things. In that sense, the market clearly works, which is people focus on the terms that matter to them. And like I was saying earlier, in an ideal world, what I would do would be to design disclosures to make it easier for people to find what they want, rather than what we've kind of constructed as this kind of Frankenstein monster hybrid system disclosures where we disclose to people what we think they should care about rather than what they actually care about. And I could talk about that later. Here's another just intuitive example, which is a comparison of these two to others. Interest rates, I'm going to skip over interest rates. We could talk about this earlier, and I don't think anybody seriously thinks that interest rates haven't fallen on credit cards in some sense. But the basic point to take away from this is that competition has changed the structure of the credit card industry, which is that when credit cards first came on the scene, they were really lousy products. They had 18% interest rate, $40 annual fee, no benefits. They were just terrible products. Competition came in, and basically the first thing you got was an elimination of annual fees in the early 90s. In the late 90s, what you got was an elimination of annual fees and a replace of high fixed rate interest with flexible interest rates and more risk tiering based on your riskiness. So it's not, a lot of people in this room probably have 9%, might even have a 9% or 10% interest rate card now. And then what we've gotten is the latest iteration is lower flexible rates, no annual fees, and more reliance on behavior-based fees, right? Late fees and that sort of thing. So that's where I think the interesting part comes in, which is the tricks and traps, right? And now I'm going to tell you whether you're right or not. Sources of revenue for bank cards. We forget about it, but the place they make their money is off of people revolving debt. It's gone from about 80% to 65%, but by and large, where most of the money is still made by credit card companies is from people revolving debt month to month, period, right? That's declined over time. The pink line is the interchange fee, which Jeff will talk about in a couple minutes, that's risen from about 10% of revenues to about 20% of revenues. The yellow is annual fees plus penalty fees, and what you see is in 1990 and in 2008, they were the same percentage. They were on total. So what happened? Well, we see is a change in the composition, which is back in 1990, and it used to be even higher. Annual fees have gone from above 5% of revenues down to about 2.5% of revenues, as annual fees have been eliminated from the market. Behavior-based fees, such as penalty fees, have risen and then dropped back down. The overall effect, as we see here, is that the total amount of fees has stayed the same. They've just changed their composition from annual fees to behavior-based fees like late fees and that sort of thing. The overall effect has been that they've remained about 10%. How much then are tricks and traps penalty fees? They've risen from about from about 4%. They went up, and now they're about 6%. So anybody who said anything above 10%, it wasn't an exam. We'll just say that. But it's still a relatively small component of their revenues. They basically make their money off of revolving debt and now, to a larger extent, interchange fees. Then have just changed their composition from annual fees to late fees. And there's some logic to that, right? Here's just breaking out those two sets of fees, and you see penalty fees, annual fees, total fees, annual plus penalty are around 10% for most of this period, right? And there's some logic to that, right? Which is an annual fee is just a tax on holding a card, regardless whether you're good risk or bad risk. Penalty fees are at least to some extent risk-based pricing. We could talk about how much, but certainly at least some of that is justified by risk. It's not just tricks and traps sort of thing. Let's see. I'll say one last word. I'm probably going longer than I promised, am I? Or am I about on time? Let me just say the final thing I want to talk about then is what happens if you engage in regulation and the unintended consequences of regulation, which is how to think about regulation. 3 things happen when you regulate credit card terms. You can get term repricing, product substitution, and rationing. Now, what do we mean by term repricing? This is just something I thought up in 30 seconds sitting at my desk about some of the terms that you have on a credit card. There's probably more, right? What this means is if you regulate half of those terms and leave the other half unregulated, what's going to happen? Well, the other terms are going to adjust in order to try to clear the market. We're in a supply and demand type situation. So where did annual fees come from in the 70s? Well, it came from the fact that states regulated interest rates. So they put a cap on what you could charge for a credit card. And so what happened was, as interest rates went up in the 70s, basically what happened is they couldn't make money off of that. So what they did was they attached an annual fee to using your card. Once they deregulated interest rates, what happened? Annual fees disappeared. Why? Because people hate annual fees. Why was it that retail cards dominated for so long before bank cards could take off? Same reason. What did retailers do? If there was a cap on the interest rate, all they did was they raised the price of the goods. And so what they found is that states that had strict usury ceilings, it would cost you, on average, a lot more for a refrigerator or electronics or something that you bought on credit. They just buried the price in the goods of the credit loss. That's why they could dominate, because that was such an easy way to reprice terms. So the point here is if you regulate some terms and leave other terms unregulated, what's going to happen is the unregulated terms are going to adjust to try to clear the market. If you place a cap on usury rate on interest rates, you're going to get annual fees, or you're going to get a shortening of the grace period, or things like that. Annual fees are an especially pernicious form of term repricing. Why? Because annual fees, as I said, are basically a tax on holding cards. The great innovation and competition for credit cards is that people routinely carry 3 or 4 credit cards in their wallet, right? My credit cards are competing right now, right? When I walk to the Metro and buy and update my card, right, to take them, to put more money on my card to go back to George Mason, at that very moment I can decide which credit card I want to use. That's pretty amazing. If I had to pay an annual fee, would I be carrying 3 or 4 credit cards in my wallet? Would I be constantly deciding which one's giving me the best deal? No, right? And what would happen? Competition would be stifled, cost would go up, quality would go down. And so for those who have kind of become very cavalier about annual fees coming in, that's a bad thing. You also could get product substitution. And we saw this last year during the credit crunch. When the credit crunch first hit, what happened was consumers were finding credit card lines slashed, unable to get credit. Layaway came back at department stores. There was greater use of payday lending, pawn shops, and that sort of thing. In the 1960s in America, the second biggest revenue source for the mafia was illegal lending. Gambling was the only bigger revenue source in the 1960s for the mafia in the cities. So if you want to get rid of payday lending and auto title lending and things like that, those things came about as an alternative to these guys. So just something to think about. So the final thing I'll say is I think the market generally works here. It's highly competitive. We could tinker around the margins, But those who say the credit card market is broken, I think, just misunderstand what's going on. And we could talk more about this. But I'll turn the podium over to Jeff to talk about interchange now.
Thanks, Todd. Thanks, everyone, for coming. It's a fascinating topic that has fascinated me for a while, and I'm glad all of a sudden it seems to be interesting to other people too, so now I get to stand up and talk about it. It's the kind of thing I never thought would be interesting to anyone. And before I start, because I don't know if I'll have a chance to get there, I was going to add an additional point to Todd's discussion of the sort of perniciousness of annual fees. Another thing about them is that they are regressive. They don't vary with the amount that you spend, right? So if you're relatively poor, if you don't have a lot of wealth, and you're spending only a little bit, you may be paying exactly the same annual fee in order to fund that ability to charge on credit as somebody for whom that $40 annual fee is completely irrelevant. And I think that's often missed in understanding the ways in which the annual fee is a bad substitute for the alternatives. So I'm not entirely sure how much time I can take, so I'll keep talking until someone tells me to shut up. No, that's not true. I'll keep talking until the people who are supposed to tell me to shut up tell me to shut up. I'm going to try to get through all of these things today, and if I don't do it in my remarks, I think we'll still have some time for questions, and of course there are ways to contact us afterward, and I'm happy to talk more about this. I'll start out talking a little bit about what an interchange fee is and what its purpose is. I think the essential question that we're here to address, especially to the extent that we're considering the Durbin Amendment and other sorts of amendments floating around to regulate interchange fees, is exactly whether they are too high and why they might be too high, assuming the intent of regulation is to lower them below the place where they are now. And then, of course, there's this meta question about whether regulation can actually accomplish what it's intended to accomplish. Part of that was already addressed by Todd when he suggested that if you regulate in one area, you may find unintended consequences in other areas that actually yield on net worse results than you had before you regulated. So hopefully we'll talk about that a little bit as well. I won't belabor this stuff too much. If you're here, you probably know what interchange is. I will just mention in the most basic of terms, it's a small fee. I call it a small fee. Obviously, some people think it's large, but on average in the U.S. right now for credit cards and debit cards together, it's less than 2%, about 1.8%. It's a fee on each transaction that's paid by a merchant. More accurately, it's paid by the merchant's bank to the issuing bank, the bank that issued the credit card that was used for the transaction, in order to, as a percentage of the value of each transaction. Presumably, and I think this is the common understanding of it, in order to finance these sorts of things, right? It is, as Todd discussed, a way that the issuing banks receive some revenue to compensate them for the expenses they incur in managing the network generally and the transaction in particular. Like Todd, this was 30 seconds sitting at my desk coming up with a list of the sorts of things that it might pay for. I'm sure there are more. I will point out that with respect to this idea that the interchange fee is a source of revenue for issuing banks, and I think Todd alluded to this as well, notice that if you're talking about card users who don't revolve their credit, who therefore don't incur interest charges, finance charges, and therefore also don't incur penalty charges, the interchange fee is the primary source of revenue to pay for those transactions. And I would just analogize then to debit, where debit is essentially like a non-revolving credit card, right? There's no way to revolve your credit on a debit card. These are transactional uses. It's not surprising because there's no significant interest fee component to the payment, to the revenue raised on debit cards, that for debit cards, interchange fees are sort of the whole game. That's how the issuing bank raises its revenue to pay for the debit cards. And also, I'll just make reference to the annual fee point. That used to be a more significant component of this, as those have been able to decline for the reasons Todd discussed. Because of the reality of term repricing, interchange has become a more significant component of the source of revenue than it once was when annual fees substituted for interchange fees. this is, as I said, sort of the common understanding, I think, of what the interchange fee is for. I think it leaves out a really, unfortunately, kind of non-intuitive but essential component of understanding what the interchange fee is about. That's this economic rationale. It's the economic understanding of its place in these networks, in these so-called two-sided markets, and we'll get to that in a minute. But for now, I think it's fair to say that at least one piece of what the interchange fee does is it's a source of revenue for the credit card issuers. So how does it work? This isn't going to show you anything. Hopefully your handouts can show you a little bit more. This is actually lifted from the recent GAO report on interchange fees, so if it doesn't show up in your handouts as well, you can find it there. The basics, I think, are probably pretty well understood to everyone. You pay $100 for something at a merchant's shop. You don't hand them the $100 directly, but you hand them your credit card. Your issuing bank promises to pay the merchant in about 3 days the $100 that you've said you owe them. The issuing bank takes a little piece out of that. So instead of actually committing to pay $100, the issuing bank commits to pay $98.30. They don't pay that money directly to the merchant. They pay that money directly to the merchant's bank, and the merchant's bank also takes out a little piece of that. I think commonly that's in the form of a flat fee rather than in the form of a percentage. But by the time the $100 you committed to pay for the product you bought from the merchant gets to the merchant, it's been reduced by, let's say, 2%, 2.2%. It depends on the card. It depends on the time of year or what year we're in. But let's just call it about 2.2%. That's what it is in this example. I want to raise one thing you can't see here. The example in the GAO report that this came from has a little chart, I guess a table at the bottom that lays out where each of these fees comes out and where they go to, and it has a mistake in it. I think it's somewhat telling. It's not a math mistake. It's a conceptual mistake. It says that so the card holder pays $100, then it subtracts out the interchange fee, and then it says the card network pays the acquirer. In this example, it's $98.30. Actually, the card network doesn't pay anything to anyone. It's important to understand the role of the card network in these sort of complicated networks, but in actual fact, none of the purchase price flows through the network. The network's role in this is, in fact, to manage the terms on which these transactions take place. And of course, they receive some compensation for that. But this is just as a matter of clarification. I think a lot of people assume that, that in the case of Visa and MasterCard anyway, they're receiving this money and they're sort of taking some of it out and they're passing it along, and that actually doesn't happen at all. It's a little more accurate to say that happens in the case of American Express and Discover, and the difference between the two is something that I will never have time for today, although I'll allude to it a couple of times, and I'm happy to talk about what the difference is if you'd like clarification on that. So before I get to explaining what I think the interchange fee is for, having told you what I think it's commonly assumed to be for, and that it does in fact do, this revenue point, I think it's important that we understand why there is such a sort of an uproar over interchange fees right now, what the source of the criticisms are, and remember, as I said at the beginning, I think the relevant question is to ask whether they are too high and why they are too high. And if we're thinking of it in terms of what the interchange fee confers, what kinds of benefits it confers on the participants in this system, that includes consumers, merchants, banks, the networks themselves, I think it's worth understanding the sources of the criticisms of that, where in fact other folks are saying, hey, look, they don't actually confer the kinds of benefits that you're saying they do. I won't go through all of these. We don't have sufficient time, but I think it's worth understanding a few of them. I think one of them that's really important to understanding the consequences of regulating interchange fee is the claim that the existence of the interchange fee raises consumer prices. Now that's another version of the kind of term repricing that Todd was just talking about, right? If a merchant in a competitive market needs to receive a sort of competitive rate of return on selling a stereo, and that competitive rate of return is being diminished by this excess fee that it has to pay, you might find that even in a competitive market, the merchant is raising the price of those goods a little bit in order to ensure that it's receiving the appropriate rate of return. I have no doubt that that happens. I have no doubt that it's also the case that merchants essentially therefore raise prices to compensate for rent, for labor, for technology, for all the sorts of things that are business costs that have to be compensated for when they're determining their pricing decisions. But it is relevant to say, if you're trying to assess whether the fee is too high or not, that it's relevant to understand that whatever the fee is, it's going to be incorporated into either the price that a merchant charges for its good or the amount of profit that it receives once it has sold its goods. And that's certainly a relevant source of the criticism that these things are too expensive. Another source of criticism, and I think this is somewhat enshrined in the Durbin Amendment, is that these things are only legitimately to pay for the variable transaction-specific costs. I'm not actually sure what the source of that criticism is. I don't see why if we acknowledge that these are just an alternate source of revenue to finance the system that allows us to use credit cards, I'm not sure why these in particular have to apply only to the marginal variable processing costs, and the banks can be presumed to be compensating themselves for fixed costs and other costs from other sources. But that is nevertheless the claim. I guess it makes some intuitive sense because these things are tied so intimately to the transaction itself. And if that's true, if it's correct that these things should only be compensating for these variable processing costs, those costs are not particularly large, and they almost certainly, although it's hard to know exactly, but they're almost certainly less than what interchange fees are right now. Now that depends on how much of the sort of fixed costs you actually attribute to variable costs. That's never an easy thing to do, but let's posit that may in fact be correct. I will take issue with the idea that it should only be compensating for those variable costs, but if that's the presumption you're coming from, then that's a relevant critique. I won't talk about this jobs points. I think it's kind of a complete red herring, but if somebody does want to talk about it, I know we're in a world now where maybe the only thing that matters is whether we're creating jobs or not. Certainly that's a claim that's been levied, that these things are a tax, that they hurt the ability of the economy to create jobs. I think that's easily dispensed with, but I unfortunately won't do it right now. Let's drop a few points down the list, and I want to mention the very last point, this theory versus empirics point. Todd spent a long time talking about a lot of the empirics behind the understanding of credit card markets, and one of the things that characterizes what I see in the interchange fee debate is a terrible lack of empiricism. And I have a few slides in a minute to talk about some of the ways in which we don't have as good a handle on this as we should. But remember, again, if your point is to figure out what the appropriate level of interchange is, if your approach to regulation is to say interchange fee is too high, it should be lowered, that means implicitly you have a sense of what the appropriate baseline is, and there's actually literally a specific number that you have in mind. That's really hard to come to via regulation if you can't even figure out what the number actually is today, and that's actually harder to do than you might think. What we do have is a lot of theories as to why these things might be too high. We have some theories about structural problems in the markets. We've had an enormous amount of discussion over and litigation over antitrust issues in credit card markets. And part of the claims that have led us to the point we are today, in fact, originally I was interested in this issue as an antitrust matter. This has been an antitrust issue for quite a long time. The very first articles on this topic were essentially antitrust articles. It's now become a financial regulatory issue, but in the background is this idea that there's some kind of structural problem that is leading to interchange fees that are set too high. That's really important if you're trying to think about how you want to regulate here. If you agree that there's a structural problem, if you think there's some kind of a structural problem, you might want to think about regulation in terms of thinking about how to fix that structural problem and then allowing the interchange fee to reach its appropriate level, given that we now have fixed whatever impediment there is in the market that is now a competitive market. Implicitly, I think implicit in the approach that's taken in every direct intervention that's happened around the world up to and including the Durbin Amendment, implicit in that is kind of a sense that we either can't do anything about or we don't know what the structural problem is, and we're just going to go right to the source of the problem. We're just going to say interchange fees are too high. We don't know why they are. We don't know exactly how to get there. We're just going to lower them by fiat. And as I'll discuss a little bit in a minute, and as Todd alluded to when he talked about the term repricing problem, that presents a lot of problems for making sure that you're getting it right. Capping interchange fees means there's going to be all kinds of shifts all over the other parts of the market, and that may actually be worse for everyone rather than better. There's a whole other set of critiques here, this sort of fairness critiques. I think one of the most important of these is this idea that the existence of the interchange fee forces cash customers to subsidize credit customers. The idea here is that if you go to the Best Buy to buy a stereo, you pay the same price whether you pay with cash or with credit. It costs more for the merchant, for Best Buy, to finance that transaction if you're using credit, because they have to pay, say, a 2% interchange fee, and therefore the people who pay with cash are effectively subsidizing the people who pay with credit. That wouldn't be the case, the story goes, if the credit card companies could charge more for, if the merchants could charge more when somebody purchases their stereo with credit. That way there could be a cash price, there could be a credit price, there would be no cross-consumer subsidization, and that's alleged to be a defect, I think, of this sort of fairness sort. I don't think the argument is that this causes deadweight loss in the economy, although you could perhaps make that argument. I think the point is it just seems unfair for those cash customers to be subsidizing the credit customers. They didn't opt for that. They didn't choose for that. I'll come back to that a little bit as I go through this, but I think I have a harder time finding the justification in that argument. My knowledge of the economics of these kinds of situations is such that I don't think there's any argument any legitimate argument to say that this kind of a cross subsidy is inherently unfair. But I'm going to unpack that in a few minutes. I think another important piece of this sort of fairness critique is the third one down, this idea of regressive reward programs. I see this a lot in the criticisms of the interchange fee, is that in particular, because the so-called legitimate portion of the interchange fee that goes to the per transaction processing cost is so low, it is alleged that the rest of the fee is used to finance these reward programs. And the argument is that these are regressive. These are offering subsidies to relatively wealthy cardholders, people who use their cards a lot. That there's no offsetting advantage to merchants from doing this, and that there's just this kind of weird subsidy that's going on the part of the issuing banks to these relatively wealthy consumers, and that if we had a world in which we did away with all of these reward programs, we'd all be better off. And then I think again, I'll skip over a couple of these. I think to restate what I said a minute ago, it's essential, if we're trying to assess the nature of the failure here, that we have a good grasp on the source of the failure and what it actually means for there to be a market failure here. Do we think that these kinds of fairness sorts of claims are things that are properly the province, that are properly considered failures? And then the second half of this bullet point is, even if it's true that we think they're problems, we really need to think realistically about what we can do about regulating them. And there is a strong lesson to be learned from the fullest experience we have with regulating these fees, which is the Australian central bank's regulation of interchange fees that started in about 2001 and continues to today, and I'll talk a little bit about that in a minute. Okay, so I said that I would talk about these empirics a little bit, and I would talk about how if your goal is to get the right fee, it's important to understand what the fee is and what it should be. That turns out to be a really difficult problem. Again, just in the interest of time, I won't go through all of these things, but it's important to understand the sources of the confusion that come in when you're talking about these fees and what they represent. So, for example, you'll often hear, let me see if I, well, let me stay on this slide for 1 minute. You'll often hear people talk about the interchange fee as the fee that the merchants pay to finance credit card transaction. Well, actually, the fee that the merchant pays to finance the credit card transaction is the merchant discount fee. And as I suggested a minute ago, a portion of that fee is not the interchange fee. It's the fee that the merchant pays to its own bank by contract to finance its own bank's portion of its participation in that transaction. If your concern is with the interchange fee, that's the fee that goes to the issuing bank, then you have to make sure you understand that you may inadvertently be talking about a number that includes a component that is actually not part of the alleged problem. Likewise, as I said a few minutes ago, there's a big difference in the way these four-party networks operate and the three-party networks operate. Usually, though, when you see the numbers thrown around about how much on an aggregate level that merchants pay for interchange fees, that incorporates all of the fees together, including Visa, MasterCard, American Express, and Discover. But it's a little bit inappropriate or at least squirrely to aggregate those all together because the role of interchange in the three-party system is so different than the role of interchange in the four-party system. And finally, then, I want to draw attention to the importance of disaggregating credit card rates from debit card rates. You'll often see it said, and I'll show this on the next slide, you'll often see it said by the merchants, and this was lifted from one of the Merchant Coalition websites, but you see this all over the place, and actually I think it's fairly accurate if you understand what it's saying. The merchants paid in 2008, I think it was, $48 billion annually in interchange fees. And notice the second box here, the fees have tripled since 2001, and the average American store now pays twice as much in swipe fees as they earn in profits. Well, there's a couple of things there to understand. One of them is that even if that's true, and it may very well be true that $48 billion is accurate in at least one sense, to the extent that we are talking about understanding and regulating credit card fees and debit card fees differently, it's worth disaggregating those two and understanding where the trends have differed. It's quite clear that the interchange rate on debit cards has decreased substantially over the years. I think I actually have a slide on this as well. Actually, I think this will show it. No, this doesn't show it. I apologize. I actually may not have a slide on this. So, but you just believe me, that's no problem, right? The rate interchange on debit cards has declined precipitously over the last 8 or so years. The rate of interchange on credit cards has actually stayed fairly flat. It's gone up a little bit, but you can see here this is actually the combined debit and credit card rate for Visa. From 2004, it's stayed pretty flat since then. 1.71, I think, is actually an accurate number for Visa. I think total, taking account of all of the credit cards, it's more like 1.8%. The rate on credit cards seems to have gone up a little bit, not by as much as, tripled since 2001. And the reason for that is the total amount that merchants may be paying for interchange has certainly, probably it's accurate to say, tripled since 2001. That's because the volume, the transaction volume that's going through credit cards and debit cards has increased probably by about triple since 2001. So if you have an interchange fee that may be increasing slightly or decreasing slightly, and the transaction volume has gone up fourfold, it will in fact be accurate to say that the merchants are paying more in interchange fees than they have before, but it's not clear that that's stated in such a way that it actually states a problem. It may just be describing the volume of transactions that are going through these payment cards. So I wanted to point this one out as well. This goes into some description of what the merchant discount fee is used for. This includes the interchange fee. This also includes the fee that goes to the acquirer. I would note here that in this description, this is from the Nielsen report, which is sort of the industry standard assessment of the credit card industry and the payment cards industry. It's acknowledged that part of these fees go to things like compensation for credit risk, network services, management reports, and all related value-added services. That's a lot more than the transaction-specific marginal processing costs. And notice that the rates have not remained steady. You see this little mountain right there in the middle. At one point, the percentage of merchant discount as a percentage of transaction was up to 1.8%. By 2008, it was down to 1.67%. There's not a sort of a direct upward sloping trajectory to these things, and that makes sense if you understand, as we hopefully will have time to do, some of the sort of the real economic import of the interchange fee. So let me let me pass over this as well in the interest of time and get to this issue of the economics of interchange. So this is not nearly as much fun as the kind of charts and tables and statistics that Todd was throwing out. This is some pretty abstract economic theory, but hopefully I can put it in terms that are pretty well intelligible. This is the general understanding of the credit card market is to describe it as a so-called two-sided market. It's a platform, it's a network that brings together two different and otherwise unrelated sets of market participants that would have a really hard time accomplishing the transaction they wanted to accomplish if there weren't some platform facilitating it. So here we have these credit card networks that bring together the merchants on the one side and the consumers on the other side, and it really matters to the efficient operation of that whole system how many consumers they're bringing in and how many merchants they've brought in. You can understand that Visa would have no success in doing what it's done if it had literally 10 merchants that accepted its card and 600 million consumers who are happy to use its card. That kind of disparity would be useless to Visa. So what Visa and these other networks are doing more than anything else is setting the terms of the exchange between the merchant and the consumer such that it induces the appropriate, proportionate number of consumers to buy their card or to use their card and merchants to accept their card. At the same time, and related to that, is this idea that what they're doing is setting the default terms of trade so that we minimize the transaction cost of having to negotiate those terms in every transaction and every relationship between every participant in these networks. There are millions of consumers who have credit cards. There are millions of merchants who accept credit cards. There are tens of thousands of banks that issue credit cards or clear credit card transactions. Can you imagine the cost of having to negotiate, for example, the price at which those transactions were going to clear every time one of these transactions occurred, or at least on a general basis between every possible combination of banks, merchants, and consumers? So one of the things the networks can do is to economize on that, which helps then in drawing in the participants because it's otherwise too prohibitively expensive to engage in the transaction. They've done a pretty good job of this, I think. What are we at? Is that 5 minutes or is that stop? I told you I was going to keep talking until you tell me to stop. All right, so this demonstrates, and again, you can't see it so well here, but this is basically the increase over time in the number of consumers using, I think this is again Visa's cards, and the number of merchants accepting their cards. The actual chart is irrelevant in the sense that the scales on either side are essentially arbitrary. What you should take from this is that the rate of increase is pretty consistent between both the number of merchants that are added to the network and the number of consumers that are added to the network. All right, so we're solving this coordination problem, getting both sides on board in the appropriate ratios. We set the default terms of trade. And then because of the nature of these markets, because what the merchants do is relevant to the consumer's decision to join into this process, and what the consumers do is relevant to the merchant's decision, you have this complicated interdependence among the participants. This is one of the sources of the difficulty in understanding the consequences of regulating something like interchange which literally sits right at the nexus of this network. It is interchange that determines the ways in which the network can reallocate costs in this system in order to reduce costs to attract more consumers or reduce cost to merchants to attract more merchants. And fiddling with that has the effect of altering the composition and the number of merchants on the one hand, consumers on the other hand, and not irrelevant to this, the banks that are participating in this whole process and issuing cards as well. And each of those little changes doesn't just affect, say, for example, the number of consumers. If you had a world in which you doubled the number of consumers who are using credit cards, that has a serious impact on the decisions that merchants make, whether to accept those cards, how to price those cards, and once they make that decision, that in turn has an effect on the consumer's decision to actually use that card or to opt into a particular network as opposed to another network. So this complicated interrelatedness is analogous to the kind of term repricing that Todd was talking about a minute ago. You shift one piece of this, and it's going to have repercussions throughout the whole network in ways that economic theory can predict, and we don't have a huge amount of empirics to describe. But as I said, in Australia, we have kind of one example. So this idea of a two-sided market, it may not be completely clear to you because I've now condensed 20 years, 30 years of economic literature into 4 minutes. But there are some examples out there that you're pretty familiar with, right? Newspapers are a two-sided market. They're bringing together advertisers and consumers. I know you thought that newspapers were actually all about providing news to people who read newspapers, but that's not what they're about at all. They're actually about advertising, and they make complicated pricing decisions to figure out how to get the right number of advertisers on board, to get the right number of consumers on board, and they are the platform at the center of that two-sided market. Shopping malls have the same effect, right? Shopping malls are bringing retailers into a place where they can also bring consumers in. They're bringing them there all together, and they have to make a pricing decision, a whole set of business decisions about how to make that happen in the appropriate way. Get too many consumers in and the mall is too crowded and it's effectively raising the price of everything that's going on there. The retailers don't want to be there. The consumers don't want to be there. You have to get the right balance. And notice that in the shopping mall context, the shopping malls could have made any range of decisions about this, but they decided to charge the retailers rent to locate in their shopping mall, and they don't charge consumers anything to park or to enter the shopping mall or to go into particular parts of the mall. They don't even often charge them for sitting on Santa's lap. But all of that could have been done differently. That just turns out to be the right way, at least for all of the shopping malls with which I'm familiar, to make sure that you get the right ratio of the two sides of this market. I said I would talk about this a little bit, and it's of sufficient importance, and it may also end up being the last thing that I talk about right now. I have 2 minutes, maybe? Okay. I do want to dwell a little bit on this cross-subsidy point. What the interchange fee does, what the pricing decisions and the business decisions at the nexus of any of these two-sided markets is doing is, as I said just a minute ago, reallocating the costs of engaging in this network transaction. So in the case, for example, of the shopping mall, in a sense, the natural price that a consumer, that a shopper at a shopping mall would incur is left where it stands. There is no, unless the shopping mall owner charged an entry fee, there would be no natural sort of cost to the consumer of entering the shopping mall. There are costs that the consumer incur. They have to pay to get there, right? There are time costs. There are all kinds of costs, and it's sort of determined by the shopping mall owner that that's the right level of total costs for them. And in order to get the right level of merchant participation on the other side, they charge them rent, and they determine exactly how much the appropriate level of rent is. In the credit card context, what happens is there are all kinds of costs in this system. This, again, is some of them off the top of my head. Some of those costs fall naturally on the merchant, some of them fall naturally on the consumer, some of them fall naturally on the issuing banks, and in particular, most of them fall on the issuing banks. And what the interchange fee allows the network operator to do is to say, look, you issuing banks here, you're taking on a huge amount of credit risk. That's one of the huge sources of costs in these systems that I think is dramatically underappreciated. You're taking on a huge amount of credit risk here. I think I have a slide on this that I'll never get to, but you can look at it in your notes. Last year, the charge-offs for credit card companies, the amount of credit that was incurred, the amount of payments made by the issuing bank to the merchant in satisfaction of a cardholder's promise to pay that was never paid by the cardholder to the issuing bank because they defaulted, was about 10% of purchase volume. That's a huge cost. I think it was $65 billion last year, if I have that number correct in my head. So the network is saying, look, you're taking on that huge cost, and if we don't do something about reallocating some of that cost somewhere else in the system, you won't be issuing enough cards, and you won't be issuing enough cards to the right kind of borrowers either, right? Because we're talking about risk here, and there are ways that credit card issuers can minimize their risk. They can loan to less risky cardholders. The network says, look, we need you, in order to balance this appropriately, to be issuing more cards and to be issuing them to, in some cases, to riskier borrowers in order to make sure that we have the right mix here. So one of the things the interchange fee does is it allows the network to reallocate some of that cost and some of these other costs as well to other parts of the system. That can be, in this case, in the case of the sort of this natural two sides of this market, it's from the card holder and its bank to the merchant and its bank. Now, it's understandable, of course, why the person on whom this burden is now falling isn't so happy about it. And that gets back to these critiques of interchange fee, almost none of which are without some merit, right? They all make a lot of sense. But if you step back and say, what's the real economic function of the interchange fee here? What is it the interchange fee is doing with respect to maximizing the size of this pie, the size of this available network to everyone who participates in it? You start to see it a little bit differently, and you start to think, well, on that score, if we start to fiddle with the interchange fee without acknowledging what the kinds of repercussions will be throughout the market, we may be messing up this whole sort of delicate network balance. All right, so I have a lot more to say. Todd has a lot more to say. We have no time, but maybe we have time for a few questions. Is that
Yeah, I wanted
correct?
to thank everybody for coming.
Can I just add a word or two on interchange to sort of sum up?
I could add a word or two.
Yeah, let me just, the basic math of this is pretty straightforward, right? Am I going the wrong direction? I put up that chart with interchange lines going up and revolving credit going down, right? Let's see. And it's the basic math of the situation is if some of those lines go down, other lines have to go up, right? Let's see if I can find the line, right? So what we see is interest has gone down, interchange has gone up. If you make that pink line go down by reducing interchange, one of those other lines has to go up. It's as simple as that, right? Which means either they've got to generate more interest revenue, which means higher interest rate, probably trying to lend more to more people, or they've got to increase annual fees and penalty fees, right? And the basic perception of the model is credit issuer or merchants are upset because they say plastic costs more than cash and checks. Well, that may seem to be the case to them, but it's because checks and cash are subsidized, right? We print the cash for them. We mandate the checks have to be cleared at par so that merchants don't have to pay the cost that they impose on the banking system. You have to pay for your own checks, right? You are the one who bears the risk of non-payment of your check, right? And so what merchants have done is basically said, take these subsidized systems over here we like and compare them to these other systems over here that we don't like. And what we want to do is make consumers subsidize us more when it comes to plastic. At least that's the way it looks to me. But that's the math of this, right? Is if you reduce interchange fees, something's got to give somewhere. They're going to have to increase revenue somewhere else. All those other revenues come from consumers, either in the form of higher annual fees, higher interest, or higher penalties. The second point is the subsidy point, right? When you open if you go to Macy's today and you buy a suit, they're going to offer to give you a Macy's credit card, right? And they're going to say, we're going to give you 15% off if you buy Macy's today. What is that? That's Macy's making cash customers subsidize Macy's credit customers. Why does Macy's do that? Because Macy's wants to give you a Macy's card, right? Let's be serious. The merchants don't care about the cross subsidies among consumers. As we talked about earlier, merchants have been making cash customers subsidize credit customers for 40 years when they were raising the price of goods in order to bury credit loss. You know, what this is about is, I think, is really not about the merchants sticking up for consumers. It's merchants sticking up for merchants. God bless them. That's what they're allowed to do, right? It's a free society. But don't fall for the idea that they're concerned about these cross subsidies because merchants do the cross subsidies all the time. Starbucks cross subsidizes every time people who drink black coffee get charged the same price as those who drink with cream and sugar, right? Are we ever going to have government intervention that says you have to charge a nickel more for everybody who puts cream and sugar in their coffee, right? I mean, it's all part of the competitive process. It's a business decision, and that's basically what I think is going on here. So, final word, I'll just say a few words about the Durbin Amendment. I published an op-ed in the Washington Times last week about this. Jeff hit the key point, which is the way the costs are calculated in the Durbin Amendment, I think, are incomplete in that they don't take account of the fixed costs of the system. And it's just going to be throwing a dart at a dartboard to get that right anyway. I've got concerns about the other aspects that apply not just to debit card, but credit cards. The minimum payment requirement, I think, is very bad. Citibank and Chase don't care whether or not you can use your credit card or your credit card to buy a coffee and bagel, right? You do care, right? You really care if you can use that. That's not a revenue source, really, those minimum payments, but it has a big deal to do with the ability of consumers to use their cards. And if a merchant could say, basically, you've got to jack up your ticket to $10 or $15 before you're allowed to use a card, that's going to be a real hardship on consumers. I could see why merchants would like that. I'm not sure why the rest of us would like that. The maximum provision there, I think, is even more troublesome. And you've probably already intuited what's going on here, right? Which is it says we can refuse to accept credit cards above a certain maximum charge level. There's no way that benefits consumers. There is no way it benefits consumers to have restricted choice when it comes to credit, when it comes to, say, buying a TV or something like that. What that really obviously is just a mechanism for merchants to steer consumers to their in-house credit programs. So, you know, the small mom and pop stores aren't going to open their own in-house credit places, but Target and Walmart and those kind of guys will and do have their own in-house credit products. And basically what they're going to do is they're going to force people with big ticket purchases towards their in-house credit operation. So I think there's a lot of troublesome things in that legislation that I think would end up hurting consumers. So, yeah.
This is anecdotal evidence of a little backlash from merchants on the credit card. I recently took, and this would apply to, you know, a big purchase, single big purchase.
Right.
I took a trip and they asked me to pay by check